Livermore Partners. David, why should we be concerned that there's a correction coming when the markets have been chasing higher and higher month after month?
Yeah, I think that people have been calling on a market correction for a long time, and that's due to valuation. So on one hand, I look at the situation and see, we're having strong global growth that's starting to manifest itself throughout the world economy. Those are all really good signs. We've had substantial uplift, obviously, over the last 7 or 8 years. And the one thing that we're concerned about is that on one hand, you have an economy that's continued to grind along, doing well, seeing strong earnings, banks are overcapitalized. We're seeing all the positives that would set you up for a nice rally and reasons why you want to be investing in equities. And at the same time, again, the rally has essentially run its course for a long time. There's tremendous complacency in the market.
Time doesn't kill a bull market, and that's what we keep on hearing. So even though some technical commentators are saying, well, this market looks ripe for a correction, a lot of the fund managers are saying global equities still present the best opportunity if you compare it to other asset classes. So what's going to be the trigger for a pullback, not just time?
Well, that's it. I'm not here saying that all of a sudden we're going to hit into a bear market and all of a sudden wipe away, a tremendous amount of gains and you should be out of the market. All I'm saying is that the level of complacency is rising and rising, and there's becoming less value opportunities in the market today. So when that happens, that breeds an opportunity where something can occur, and therefore I see a deep and prolonged correction in the market.
Andrea, I can't see you agreeing, given you want rate hikes across different economies. I can't see you expecting a correction.
Yeah, there are three things that economists are not very good at predicting: the oil price, the exchange rate, and the stock market.
The price, the exchange rate, and the economy.
And I'm not sure I'm going to make predictions about the stock market per se, but global equities, with a reasonably strong world economy and the potential of dividend growth and the potential of further growth next year, still look quite attractive to me.
Why is Mr. Mnuchin right or wrong to tie the level of the stock market with getting Trump's agenda through as well? It seems to me that they're playing a dangerous game, and the president's playing a dangerous game by touting the gains we've seen since his election and saying that's pretty much implying it's a direct correlation of what his administration is or not doing. Do you think Mr. Mnuchin is playing a dangerous game?
I want to say he's playing a dangerous game. I think the market's anticipating change from the current administration. They're starting to see some of the things manifest through. The question, of course, is do they become law and when? And the market will build that in, and the longer it takes, they'll start to pull it out as well. So, I mean, those are some of the political uncertainties, I would say, that are not in the market today, and that essentially could lead to a correction. But look, overall, again, the markets are highly valued. That doesn't mean you sell and go to cash. That doesn't mean we're about to hit a cliff or something. All I'm suggesting is that, from Livermore's point of view, we're finding less and less opportunities to stick to investments that we thought had a lot of value in the past years, and therefore, when you start scratching your head, that just, hopes and dreams of seeing higher valuation is not how we invest capital.
What about around Brexit? You were raking over some of the names here in the UK around what is an uncertain event for a lot of investors. What have your calls been, and what do you see as opportunities still?
Well, yeah, I mean, so Brexit to us, or at least the announcement that Brexit was one of those opportunities. You had a high volatility trade, you had great panic in a very short period of time, and as you know, Karen, so we were investors in a lot of companies at that time. Burberry, Entertainment One, Glencore, but again, to my point, is all those stocks have rallied now 50%. Glencore's rallied multiples, and we've shaved down those positions, and we think they have room to run higher, but it's going to take a while. I mean, there has to be a point in which you see some consolidation of equities, and some of the valuations build into their profile, and that's not occurring.
Does that give us an indication of why there's so much activism now across Europe? And typically it was sort of really just in the States you saw activist investors get involved in trying to push management to come up with fresh strategies or divestments to do something. But here in Europe, Axon Nobel, Nestle, BH Mobility and Credit Suisse, just to name a few, is that because there's nothing left to play for? So some of the lower margin stories, you've got activist investors now agitating for change.
Well, yeah, and look, that's where our focus is, right, for Livermore. And the reason why is, you've had passive investment gain so much where the markets and the indexes are, like we said, are at highs, and yet there's a number of companies that are still underperforming. And, with that, you want to dig into those situations and find out why and look to alter strategy where optimal. And that's our focus, and I think there's a lot of other investors that are focusing on that as well, because they're trying to see the disconnect as to why some stocks are trading at very high multiples and others at fairly low multiples, and why is that, and if there could be a more proactive approach.
David, thank you so much for joining us and stopping by to see us. David Neuhauser, Managing Director at Livermore Partners.
Okay, let's get back to one of the top stories.